So it's been quite a week regarding the stock market this past week, as each day came with its ups and downs. But there has only been more news leading to more uncertainty. And as we all should know, heightened levels of uncertainty lead to volatility and sell-offs, and ultimately then opportunities for all of us longer-term investors. But more on all of that to come shortly. If you're new here, I'm Ari, your dividend investor here on YouTube, looking to share all the need-to-know economic insights and dividend stock ideas with you on a weekly basis so you can ultimately drive more passive dividend income. With that, let's dive right in. So as we always do, we're going to start off with an account update, whereas my brokerage account is sitting at $121,687.23, which is up substantially not because of any sort of recovery in my investments, but because I added a few $1,000s into the account from my reserves to take full advantage of the buying opportunities that I really think are about to come about. But before I get to some of those opportunities, I certainly want to break down what I think you absolutely need to be aware of as an investor, especially this week. First and foremost, as many of you know, there is a war that has captivated the entire world's attention, as it should, between Israel and the terror organization Hamas, following the terror attacks on Israeli civilians on October 7th, a day that will forever be remembered as Israel's 9/11. Now, that matters, because there's certainly a ripple effect there. As America backs up its strongest ally, Israel, Russia then enters the picture, and so too does Iran. This ultimately will cause trouble when it comes to oil, so expect supply and demand shifts to take place. That is also amidst the treasury yields that are fluctuating, yet rising, as well as the same environment that we've been dealing with, and that's not good for businesses. That's rising interest rates, sticky inflation, and just a very unknown economic future. But don't be afraid of uncertainty. Humanity will prevail, terrorism will never win, and the market will ultimately, over the longer course of time, just experience greener and greener days. So that means now, right now, we need to be shopping the investment opportunities that are available to us that will continue to allow us to enjoy plenty of profitability thanks to their ability to grow despite the various market conditions that we're experiencing. Which leads me to the first dividend stock that we have on our list, Realty Income, ticker symbol O. Now, this stock has been battered down for some time now, has a lot of investors worried about its future, as well as the dividend sustainability, while almost trading at some of the lowest of lows at $49 per share, which is nearly 17% down year to date, which may seem alarming until you realize that many real estate investment trusts have been tanking lately for the sole reason of interest rates rising, and the question then comes to which ones are going to be the ones to invest into. But when it comes to Realty Income, the largest net lease solutions REIT in the world with over 13,000 properties covering all 50 states and with an international presence as well with over 1,300 clients to fill each property, I'm really not worried. And a matter of fact, as a dividend investor, I'm still loving Realty Income. I mean, we can just have a look here at the last 5 years where we can see over 13.5% worth of growth. That's amidst all the worst economic conditions that this company could have possibly experienced. And as we look into the future, analysts foresee a recovery with over 28% worth of upside, coming up to a share price of $64.13 per share. Now, until then, we're also going to enjoy this monthly dividend at a 6.03% dividend yield that has been steadily growing over the last 25 plus years at a rate of 3.7%. Next up, a beverage behemoth that doubles as a salty snack king. We have Pepsi, ticker symbol PEP, which has also slid on the year, down by 8.7% year to date, as it's trading for $162 per share with a PE ratio at 26.8, to which many may not think that's discounted, but the reality is, it's not likely it's going to hit much lower valuations. Yet it remains an incredibly strong investment for decades to come. After all, we are talking about 68+% worth of growth over the last 5 years. Now, when it comes to Pepsi, because it's so diversified, it grants investors both safety and reliability. But it also allows Pepsi to expand in multiple areas, particularly when it comes to those salty snacks, which certainly fires up a lot of analysts, whereas we see over 15% worth of growth still expected, should the share price hit its forecasted price of $186.43 per share. Not to mention plenty of hedge funds that have actively been buying Pepsi up over the last quarter, over 4.1 million shares worth. And while it may be in the business of salty snacks, it's maintained a very sweet dividend over the last 50 years at a 6.87% growth rate with a current dividend yield at 3.16%. And while on the topic of snacking, how about we go right for an entire meal with McDonald's, ticker symbol MCD, the largest fast food chain and less spoken about real estate empire in the world, with over 47,000 acres of land owned by making Ronald and the gang quite indestructible. Yet not untouchable from market volatility, as we can see McDonald's is down year to date by 3.4%, trading for $256 per share, which is down from nearly $300 per share just months ago, with a P/E ratio at 23.1. Again, just another stock that's never going to be steeply discounted, but a company that we should really consider given its value it's gifting its shareholders. After all, it shot up by over 70% over the last 5 years alone, despite the market mayhem during the same period of time, which makes analysts optimistic as they forecast a future share price coming in at $326.57 per share. It's over 27% worth of upside, with plenty of hedge funds already loving it and buying more shares for themselves as of last quarter. But McDonald's comes with even more than just a Happy Meal and the fries. We're talking about a dividend investor's dream with over 21 years worth of dividend growth at an 8.52% growth rate and a current dividend yield at 2.66%. Now, investors, before we get to the remaining 4 stocks, I do want to take just a quick moment to thank you for your viewership, but moreover, really ask that if this video has been delivering value to you, you tap on that thumbs up button for me, and it will help me understand that I need to make content just like this more often. With that, we're going to discuss Starbucks, ticker symbol SBUX, as it continues to slide, already down on the year by 5%, trading for $93 per share, and that's after hitting a peak earlier on in the year of over $114 per share. But with the macro economy as is, consumer trends shifting, we're only going to find ourselves with longer term opportunities in Starbucks and a great position right now to actually get invested into it. And that's exactly what smart money has been doing, along with analysts who have been forecasting a rebound here with Starbucks, with the price jumping back up to $113.47 per share. It's over 21% worth of upside. And given Starbucks' dominance within the industry and just continuous growth as they scale their locations, their dividend will also likely be growing, as it has for 12 straight years now, at a 10.97% growth rate and a current yield at 2.42%. Next up, United Parcel Services, or better known as their ticker, UPS, which has been suffering the fate of a company that is directly impacted by higher interest rates and inflation, as well as, I guess, now a war. But that changes supply and demand shifts. We see UPS down 8% year to date, trading for $153 per share at a P ratio of just 13.6. But UPS is always about the longer term. After all, we see 58+% over the last 5 years, which is notable because that same period has been trivial, but shipping and logistics is not something that humanity can just forgo, which leads to optimistic analysts with a forecasted share price coming in at $184.06 per share. That's about 20% worth of upside. And of course, we are seeing plenty of optimistic hedge funds as well, leading to over 447,000 shares being purchased last quarter. However, us dividend investors, we're going to get the real fruits of this investment with the dividend, as these insights are coming in as such. 13 years worth of growth at 12.38% worth of a growth rate, with a dividend yield currently sitting at 4.12%. But if you're looking to perhaps enjoy a bit more of a wild card amidst our economic environment, you're going to find that wild card with T. Rowe Price, ticker symbol TROW. Certainly going to give you a run for your money, as T. Rowe is a global money management firm that has become very well respected within the industry, yet it's currently beaten down by roughly 4.5% on the year, trading once again for underneath $100 per share at a P ratio of 15, to which you can see that it's already popped back up twice over $120 per share throughout the past year as the market heated up, but it came tumbling back down because the vast majority of T. Rowe Price's assets are actually tied up in the NASDAQ, meaning tech companies have been hit very hard, yet great investments during green or bull runs. Nonetheless, T. Rowe did in fact drive over 21% worth of growth over the last 5-year period, despite all of that market mayhem. And as the stock plummeted this go round, well, hedge funds went ahead to once again just scoop up more shares worth of T. Rowe Price. But in regards to T. Rowe's dividend insights, which is why it's on the list today, T. Rowe has 36 years worth of growth with a 12.73% growth rate over the last 5 years, resulting in a 4.84% dividend yield as we speak. Next up here, we have the one stock that I have been mentioning time and time again, at least in the last handful of my videos. It's Texas Instruments, ticker symbol TXN, which I'll keep this one short, is a semiconductor investment that has been impacted by higher interest rates and, of course, businesses and consumers just letting up on their purchasing. Yet their future remains just chipper. But as for now, it trades for $151 per share, which is down by 3.4% on the year, with the PE ratio below 20 at 18.5. Longer term here, we can see growth, and it already has been growing over the last 5 years, 77% worth of growth. Now, analysts first see Texas Instruments powering back up to over $179 per share. That's over 18% worth of growth heading our way as hedge funds also peak more interest into the company as well. But most importantly for dividend investors, it's the insights here. Texas Instruments comes in stronger than the rest of today's picks with 17 years worth of consecutive dividend growth at a current rate of 14.87% and a dividend yield at 3.37%. Now, investors, comment down below with all of your thoughts on these 7 dividend stocks. Let me know if you own any of them, if you're going to be buying any of these stocks, and of course, enjoy more dividend insights right here in this video. But before you click away, be sure to subscribe so you never miss out on exceptional dividend stock ideas.